All right, everyone. Dominion Energy, ticker symbol D. This is a regulated electric utility that is based out of Richmond, Virginia. I'm going to review that stock today. I'm going to do a deep dive analysis. Thug Life subscriber request. Also, I'm going to talk about some controversy today. I'll link in the description below my last video. It generated a little bit of controversy. I want to talk about this controversy because I believe certain investors, they're looking at this thing completely wrong. And so I want to share some knowledge. I want to share some insights, some data, some statistics that basically informs the community. And so, by the way, I'm sweaty. Don't hate on me for my appearance. I'm doing the best I can, Thug Life, to get this dividend content out. This is going to be an amazing video. I just got home from 5 hours of driving, and it's really hot here right now in my garage. So I'm doing my best, everyone. Don't hate on me for the sweat, but this is going to be an amazing video. I am serious. Let's get ready to talk about dividends. I love Richmond, Virginia, by the way. This is home. This city is home to many of the sin stocks that I invest in as a Thug Life investor. And so shout out if you're in Richmond, Virginia, please give a comment in the comment section below. I love you all. So Dominion Energy, regulated electric utility. They operate in 16 states. They do all kinds of stuff. They do wholesale energy. They have regulated electric utility. They do gas pipelines. They do gas delivery. My understanding from looking at it so far is the two states where they do the most regulated electricity are Virginia and North Carolina. And it seems like in South Carolina, they've got some gas going on, gas pipelines, etc. And so they're a diversified energy company. But what attracts me to them the most is the fact that they're regulated. Regulated utilities, they cannot have competition. They're regulated and they have a legally regulated monopoly, if you will. And so I love this industry. It tends to have higher dividend yields, great for income investors, tends to carry a little bit less risk, although Pacific Gas and Electric, PG&E, all shows us that there's a little more risk in this sector than we all think. That's why I like to diversify. That's why I own Southern Corporation. I own Duke. I own PPL, a new stock that I started buying, and Hawaiian Electric. I've got them all. And so Dominion, it's a new one I'm looking at. And I had been following it for a while, but it piqued my interest when some of you reached out and asked me, what do I think about Dominion? So a few things I want to discuss at a high level before I jump into the numbers. One thing is they're working on this Atlantic Coast pipeline. I read about this in their 10K. It's going to cost them $7 to $7.5 billion in cost. This is a pipeline to carry gas, natural gas. And so one of the things to be aware of with energy companies, with utilities, is the infrastructure cost is huge. And so when you look at these companies, they tend to have a lot of assets, as these are real assets, they're worth real money, but they also tend to have huge, enormous debt. And so debt is the name of the game in this industry, but it all works because it's regulated and they can push price increases through to the consumer with the government's help, and they have a regulated monopoly in these markets. And so I love this industry. I really do. And when you guys asked about Dominion, I wanted to look at it right away. And so one of the things that they also mentioned is in 2018, they begun a 10-year, $3 billion upgrade to their electric grid in Virginia. So you can see very quickly when you're reading the 10K, when you're reading the annual report, the quarterly reports, the press releases, this is an infrastructure-heavy business. It costs a lot of money to be in the utility business, constantly upgrading. And so just something to be aware of. If you're an investor who doesn't like a lot of debt, if you're an investor who doesn't like a lot of overhead in terms of infrastructure, maybe you want to look for software companies then, because definitely in the utility space, you're not going to find that huge debt. Dominion, one potential red flag, not a huge red flag, but I was reading in their 10K, there was some drama around this master limited partnership. They had something called Dominion Energy Midstream Partners, and they were kind of using this potentially as a tax entity, as a tax efficient entity. And it seems like others in their industry, some of the others who were involved in these pipelines and this wholesale energy, they had participated in these kind of MLPs as well. It just so happens when I was reading their 10K, it seems that the rules, the laws, as it pertains to these MLPs changed. Their MLP lost a lot of value. They had to acquire it back. And the stock, it actually took a plunge. When I look at December of 2017, it was at $84.91. When I look at June of 2018, it dropped down to $62.60. Now it's recovered, by the way. You'll see that soon. I'm going to share some data on the screen. But I believe a lot of this drop was probably related to drama with the MLP. It seems like they've kind of righted that right now. But the one thing this all shows me is, boy, I wish I was looking at Dominion during the drama. Boy, I wish I was looking at Dominion back in June of 2018 when it's at $62. And so that certainly would have been exciting, and now it's recovered. And so for me, when I'm looking at any stocks, even something like PPL, you'll see this in a minute. PPL, I think it's a value now. It's a value because there's a lot of drama with Brexit, and that's created an opportunity. Well, Dominion, is it the right opportunity right now? Maybe, but it was a much better opportunity in 2018 when it tanked. And so something worth pointing out. They, when you look at the long-term chart, one thing I like about Dominion is it's up and to the right. That shows over the long term that this company has performed. This company has done well. The chart over the long term, generally, in my opinion, is a reflection of business performance. So it's nice to see that. Over the last 5 years, however, this thing has been sideways. And sometimes it's nice to accumulate a good dividend stock going sideways, because when it goes up, starting yields go down. And so I always like a bargain. I always like to buy with better starting yields. So it's nice to see it going sideways. A lot of that may even be related to this MLP drama. But drop a comment below if you're more familiar with Dominion than I am. Your shareholder in Dominion know a little bit more about the MLP drama, other stuff they're facing. Share it in the comments below. These guys do have a nuclear power plant. Some people don't like that because there's more risk with it. PPL, for example, is really coal driven. I kind of like coal. A lot of people talk down about coal. Shout out to all the coal miners out there. Coal, the good thing about it is there's certain issues, obviously, but at least it can't have as big of a catastrophe, in my opinion, as nuclear. That being said, nuclear, a lot of the technologies these days, from my understanding at least, is they're regulated very well. They're very robust. They're very stable. There's less risk than there used to be. And so there's something worth pointing out. Whether one of these regulated utilities is coal versus nuclear, I honestly don't care that much because I diversify. I have them all. I've got Southern, Duke, I've got PPL and Hawaiian Electric. And so I have all of the different sources of power generation. But it just so happens that for Dominion, at least, part of their portfolio comes from nuclear. And so I want to jump now into the financial analysis. I want to share some things that I'm seeing with the financial analysis. And so I'm going to start sharing stuff on the screen with you all so that you can see what I'm seeing when I looked at Dominion and I compared it to all the other utilities that I'm really familiar with. So basically what you'll see on the screen right now is my comparison. This is just a really quick industry comparison, but you can see Dominion, it's trading now at $80.23. The forward analyst estimate for 2019 EPS earnings per share is $4.18. If I take the current share price, I divide by that EPS estimate, I get a PE right now of 19. A PE of 19 for a regulated electric utility, it's pretty expensive. That being said, if you look across the board, other than PPL, this is actually lower, slightly lower than Duke, 1 point lower than Southern. And you can see Duke, Southern, Dominion, they are all priced to perfection. The reason for that is it's hard for investors to get yield these days. And so people who would otherwise invest in bonds, for example, are coming into dividend stocks just to get the yield. It's pushing the price up. They are expensive. And so Dominion, it's less expensive than Southern and Duke, but it's up there. It's a lot more expensive than PPL. PPL has, generally speaking, a slower growth rate and a little bit more drama because of Brexit. Next, I look at the dividend. It's $3.68 per share. If I take that, I divide by the share price, I get a 4.59% starting yield. This is good. This is second only to PPL, so it's a higher starting yield than Duke and Southern. And so that's something that's really nice to see with Dominion get more cash up front. That being said, if I calculate the payout ratio, I take the dividends as a percentage of my 2019 forward EPS, I get a payout ratio of Dominion of 88%. This is pretty high. They are paying out most of their earnings as dividends. Whereas with Southern, it's at 81, Duke 75.9, PPL 67.8. And so you can quickly see that on a dividend yield basis, it is attractive, but is it really that attractive? The payout ratio is really high, leaving little room for them to grow the dividend going forward. And so there's pros and cons here. But generally speaking, I look at all of this. I look at PPL and I see a clear value. Lower payout ratio, higher yield, lower PE. Duke and Southern are more expensive than Dominion. That being said, they do have lower payout ratios. And in general, you'll see in a minute, they're probably doing a little bit better in terms of growth. And so this is just my high-level comparison of these stocks. Next, I want to jump on to just the dividend history. This is a channel about investing for dividends. I'll tell you, the dividend history, it has some bearing on my decisions to buy stocks, but by no means do I buy a stock based on dividend alone. It takes very in-depth financial analysis. And so this is a note to everyone out there. You definitely don't want to buy a company just because it pays a dividend or just because the dividend looks attractive. You want to look at the complete financial picture and then pick the stock based on that. And surely dividends can play into it, but it shouldn't be the only factor. Anyways, I compare the dividend history for Dominion versus PPL. So I'm going to share this on the screen. When you look at PPL, stock I bought recently, it's already going up. I wish it would slow down. I just want to buy more and it just keeps going up. I'm seeing this with a bunch of my stocks right now. Anyways, the dividend per share right now per year is $1.648. And 5 years ago, it was 1.492. So basically, the dividend 5-year compound annual growth rate, if I annualize the growth rate over the 5 years for PPL, it's been 2%, 2.01 per year. Basically, PPL dividend, it's just growth. It's kind of keeping up with inflation, 2%. Payout ratio, we talked about this, 67.82. Now, when I look at Dominion, this is what's going to surprise you. In 2014, it was at $2.40 per year dividend. Now it's at $3.68 per year. The compound annual growth rate over the last 5 years for Dominion has been a staggering 8.92%. And so you look at this and it might almost trick certain dividend investors because you look, hey, the starting yield's high and hey, it's growing the dividend quicker than its peer, PPL. It's growing it a lot faster, 8% per year. Then, however, you need to take a step back. You need to look at the payout ratio. Payout ratio 88% for Dominion. Will that allow them to continue to grow the dividend as quickly as they have been? I don't think so. And so for me, I don't really think the compound annual growth rate of the dividend at Dominion applies to the future. And that's based on my payout ratio analysis. So I want to move on now, and I want to look at Dominion versus some of the peers. And so I'm going to share on the screen Dominion stats over the last 5 years. And I'm also going to share PPL, Duke, and Southern. And so this is going to be a really interesting comparison. It's a lot of numbers, a lot of data, I know. But it's really important to look at it this way because these are some of the most important fundamentals that you could look at. This is income statement information. It gives a snapshot of how the revenue, the earnings are doing in the margins. And so Dominion, when I look at 2018 and I look at it versus 2014, it has increased its revenue by 7%. And so that's respectable. The revenue is up over those 5 years. Now, with PPL, the revenue is basically down. It is minus 1%. And so Dominion is doing better there. But if you look at Duke, it's up 9%. And if you look at Southern, it's up 27%. For me, there's a lot of stuff that can happen with earnings in the regulated electric utility space. So I like to look at top line revenue because it gives a better sense of growth. Earnings obviously are really important. Ultimately, you can pay the bills with earnings, not revenue. But earnings, sometimes they get a little skewed because of capital intensive projects and investments that are made one year and not the next in terms of infrastructure. And so it can skew it a bit. That's why I like top line revenue, just to get a gauge of where these companies are going, especially in the utilities industry in particular. Now, if I look at Dominion, one thing worth noting is the operating income, it is way up. The net income, it is way up. It is up. Net income is up 87% over these 5 years. Now, like I said, this makes it look the best in terms of, and it's the best in terms of net income growth. But again, I didn't take a full look into 2014 and why the net income was so low, but these numbers can be deceptive, and that's why I like to look at top-line revenue as well, because the net income, it's probably skyrocketing because there's probably some extraneous event in 2014 that kept it really low. It's not that they're really growing the business 87% in 5 years. Now, you look by contrast, PPL, 5% net income growth, and 42% for Duke, and 13% for Southern. And so all of these companies, honestly, net income are trending up. I look at Dominion, obviously, is the best, but again, I take that with a grain of salt. I'm a little bit careful because it could be deceptive, and that's why the top line revenue was more important to me. Now, one statistic that's really important here that I love is the margins. I look at the operating margin, I look at the net margin, and what's great about Dominion, it's second only to PPL. And honestly, PPL, the reason it's so high is they have the business in the UK. For whatever reason, the margins are phenomenal in the UK. And that's one of the reasons I love you, PPL. I love you so much, and I wish your share price would come back down because I am tired of seeing it go up so quickly. Anyways, the operating margin for Dominion is 27%. PPL is 37%, but Duke is 19%. Southern is 18%. You can clearly see that Dominion has a better operating margin, so they're more effective at their business. They have a better margin. It might quite frankly be that their business is of different scope because they're in a lot of things. They're in these pipelines, they're in wholesale. They may be exposed to different aspects of the energy industry as compared to Duke and Southern. That may be one reason, quite frankly, that the margins are better. You look at the net margins for Dominion, 18%. PPL is 23%. Boy, it's fascinating to see how high that is for Dominion. PPL, obviously, I already knew that because it has that UK subsidiary. Duke is at 11, Southern is at 10. Generally speaking, I like businesses that have better margins. And so, again, this was nice to see with Dominion. Companies growing, a top line, dividend is good. It's the highest of the peer set other than PPL. It has a okay PE, and margins are great. Would I buy Dominion here? Probably not quite yet. I don't really need another utility now. If I were buying more utility, which actually, quite frankly, I am, I'd rather put my money in PPL, bring it to size. But looking in the future, I kind of have a soft spot, if you will, for these regulated electric utilities. And so, hey, Dominion may be in the cards one day. And I want to show you next why that's the case as well. So I'm going to move on. I'm going to show this on the screen. I want to talk now about a debt comparison. If you are interested in investing in utilities like I do, I love utilities, take a look at debt. Debt is high at these companies. They need to manage the debt. You need to look at debt as compared to assets. Definitely, I don't like utilities where the debt is higher than the assets, and so that is risky. Take a look at this. So what I do is I look at it kind of two ways. I look at debt as compared to assets, but I also look at debt as compared to market capitalization. And so if I look at debt as compared to market cap, let's start with that. So this is the top of this table here. Dominion, it has a market cap of $64 billion. Long-term debt is $31 billion. And so the ratio of long-term debt to market cap is 48%. If you look at Southern, Duke, and PPL, it is higher with all of those. And so it honestly shows as compared to those, the debt is probably managed as compared to market cap a little bit better. By the way, I know a lot of investors don't look at it this way. This is my own metric. I invented this metric. It's just my way of looking at things. So just keep that in mind. But I'll get to a more standard way of looking at things next. So next, what I do, though, is I don't just look at long-term debt. I include short-term debt. I include deferred credits and non-concurrent liabilities. You have to be real careful with these utility companies. They hide a lot of their long-term debt, their real debt, if you will, in these non-concurrent liabilities. And so just keep that in mind when you're looking at them. So when I add them all up, total debt at Duke now is $55 billion. If I take the $55 billion and I compare it to their market cap, it is 0.86. It's 86% of their market cap. By contrast, with PPL, Duke, and Southern, the total debt is higher than all of their market caps. And so there's kind of two ways of looking at this. Either the market cap of Dominion is way, way overvalued, or the debt is managed better than the others. It could be looked at either way. I didn't make any conclusions from this first way of looking at it. It's just a quick way to kind of understand their debt, the magnitude of the debt as compared to the magnitude of the company. Next, I look at debt versus assets. And so let's check this out. When I look at the ratio of long-term debt versus assets for Dominion, I get 0.4. This is actually higher than Southern and Duke, but it is lower than PPL. That said, again, this isn't the full picture. There at these companies, there are non-concurrent liabilities, and so that's something totally to keep in mind. So when you look at total debt, short-term, long-term, deferred credits, non-concurrent liabilities, I get a ratio of debt to assets of 72% for Dominion. And so Dominion, it's very similar. It's a little bit better than Southern, which is at a 75%. It's a little worse than Duke, which is at 70%. And it's, just a little bit better than PPL, which is at 73. What the debt comparison here tells me is that more or less Dominion is managing its debt well. It's managing the debt similarly to Duke, to Southern, to PPL. And so for me, this just gives me confidence in Dominion. So net, I look at everything here. What do I see? I see a big regulated electric utility. I like the starting yield. I hate the payout ratio. It's a little too high. So it forces me not to like the starting yield as much because it's because of the high payout ratio. I like the revenue growth. I love the margins. I love them, love the margins. Debt, it's fine to me. It passes my test because it's the same as all the other ones I own when I look at it as compared to assets, which is ultimately the way to look at it, I believe, in this industry. And so where am I left with Dominion? I see a company with a PE of 19. I sure wish I bought it last year in 2018 when it plummeted. I did not. Right now, I add it to the watch list. I sit on the sidelines and I wait. If I see this thing fall down from the 80s, maybe back to the 70s or 60s, I take a look. Until then, I will add to my PPL because it still has a PE in the 12s. And so I'm going to flash that chart on the screen again that gives just a high-level comparison of all of these companies. When I look at my PPL, the forward PE is a 12.85. I just cannot buy Dominion when I see PPL at that level. And yeah, PPL carries more risk. Yeah, it's got all the UK drama with Brexit. But for me, that's the one I'm adding to now. And it has a higher dividend, lower payout ratio, opportunity to increase the dividend over time. That being said, Dominion is a strong company. It stands on solid ground with all of these, with Duke, with Southern, with PPL. And I will watch this company. And look, let's say I didn't own Duke and Southern and I own Dominion instead. Let's say I move the positions around. I would feel very comfortable owning Dominion here. It seems like a good company to me based on this very quick look. By the way, if I wanted to take it to the next level and I were going to actually buy Dominion, I would probably look into a little bit more. I'd start looking to their statement of cash flows. I'd really get to know the lines of business a little better. I didn't take the time to do that. I'd want to understand the pipelines, the wholesale, the trading, some of that stuff. Quite frankly, I'll tell you, I'm going to leave you with one last thing. With Dominion. One of the things people ask me, Ian, why don't you invest in Kinder Morgan or the related companies to that? I think there's another one called Line, Line. There's these different companies related to pipelines and MLPs, this and that. Quite frankly, the reason I don't invest in that stuff, and it may be a really bad reason, but I remember Enron. I never invested in Enron, but it left a sour taste in my mouth for all of that stuff. And so for me, I know Enron, hey, all that's in the past. These new companies, they're doing it the right way. They're doing it differently. I can't get past the past. And so one of the things, if I'm nitpicking with Dominion that I don't like as much, PPL, really clear-cut, easy to understand company. Dominion, they got all this stuff going on, trading energy, wholesale pipelines, this and that. They did this MLP thing. It blew up. They had to buy it back, this and that. It kind of reminds me of this kind of weirdness that goes on with companies in that type of sphere like Enron and then Kinder Morgan, that type of stuff. And I'm not trying to say Kinder Morgan's bad, Line is bad, any of these, but I'm just saying for me, sometimes I just have a bias against stuff. And I'll tell you, these kinds of companies, I have a little bit of a bias against. And for me as a long-term investor, buy and hold forever, I have to feel really good about what I'm buying. And I'm telling you, just PPL, I love it. I feel good. Southern Duke. And I'm sure Southern Duke have some of this stuff going on too. If I had to guess, I'm not experts at every little thing they do. Maybe they're just like Dominion. But just the sense I got is I don't remember MLP issues with Southern and Duke. And so that's why I take one kind of subtract a point off of Dominion for that. Because it gets me thinking. It gets me thinking about the past. Gets me thinking about my worldview and my aversion to drama from the past that came out of all that Enron stuff. And so anyways, look, this is probably not a good argument at all, but it is good for me because if I'm a dividend investor, I'm buy and hold forever, I have to be really committed to something. Those biases, they come into play and I have to love the stocks I'm buying. That said, Dominion, solid watch list stock. The PE ever gets down to like a 14 or 15, I'll take a close look at it. Until then, I'm buying my PPL, and I'm holding my Duke and Southern. I'm not adding to Duke and Southern here other than reinvestment, because those companies are very fairly valued at this point as well. And so that's that. All right, part 2 of today's video. There's going to be a lot of knowledge dropped here. I want to jump into a few things. But anyways, I made a comment in my last video about the cost of college. And I made a comment how I'm trying to save up approximately $500,000 per child to send them to college. I want to dive into this a little bit more. One, to clarify what I said so you understand where I'm coming from a little bit better. But basically, when I made this comment, there was some negative sentiments. Most people were supportive, but some people were like, hey, Ian, I didn't know you were some huge hotshot, multi-millionaire, all this money. You can afford to send your kids off to Stanford and this and that, so on and so forth. First, I'm not trying to pick on anyone. I love you all. I'm using this as an example because I think it's important. First and foremost, just a little rant here. When parents, even if they have a lot of money, you can't just send your kids to Stanford. It is incredibly hard to get into that kind of university, and the kids, they have to earn it. They have to earn it. Now, I understand there's all this drama now with college admissions, and these celebrities are in the news and this and that. There will always be bad apples. There will always be exceptions. But I'm saying most of the people who get into Stanford, it's not because their parents sent them there. It's because they worked really hard and they have a gift of different types. Some people might be gifted in math, some people at athletics, some people might have a gift of music, some people creative and art. The admissions team will look for gifted people and will reward them, those who worked hard enough with the luck of getting in. Now, anyways, I just wanted to qualify that because I think there's this misconception people just go to Stanford or higher education if their parents want to send them. That is not the case. But I'm going to get into a lot of stuff here, so I got to go quick and I don't want to linger on anything too much. But anyways, I said all of this and I mentioned, look, I started my daughter's college fund with $5,000. I'm 1% of my way to the goal. And apparently this just triggered people saying all these things like you're a millionaire and how could you just afford to spend that much on college, this and that. I haven't disclosed my personal portfolio value here on YouTube for a reason. And I think people are out there just making assumptions, this and that. But first and foremost, personal finance 101. Do not have a negative sentiment about money. Do not have a negative sentiment about people who may have more money than you, and so on and so forth. Because if you have a negative sentiment about money, I truly believe that you're pushing the money away. And quite frankly, you're just making yourself unhappy. And so I'll tell you, just in my personal circle, I consider myself, look, I'm very blessed. I've done well. I'm very proud of myself and my family. And I thank God. I really am blessed and lucky. And I try to use my success to give back in many different ways. And so small ways, like today, for example, I left a $20 tip at Starbucks. And sometimes bigger ways. I just made a relatively large donation to Musicians on Call, which is a nonprofit. I sponsored a hospital room for an entire year. And so the challenge, though, that I see is there are some people that have this negative sentiment and they think, hey, if someone has more money than me, I can't listen to that person about their journey or I can't learn from their journey. And so this is really the wrong way of looking at it. For me in particular, I actually think in terms of money out of like the people I look up to or I know, or people even who just live near me that I might not know. Most of them, I believe, are doing better. They're doing even better. And so I don't get negative about that. I actually use that as motivation. I use it as motivation, and I like to learn from people who have more money, who have less money. And so that's just topic one, is just if you find yourself falling into that trap, you see someone and they're talking about something and it makes you feel kind of angry or upset or just, like, hey, why did they have more, this or that? Comparing yourself to others, it's just, I've never found anything good coming from it in doing it in a negative way. And so I think personal finance, number one, have a positive attitude towards money, have a positive attitude towards everyone out there, and realize you can learn something from everyone. And so this brings me to my next point, which I think is so important. Great investors are at all levels. And so I'm going to tell you something. shout out. I don't know if he's watching the video or not. Sometimes he does. One time at least I know, because I reviewed him as one of my favorite bloggers on the internet. Jason Fieber, Mr. Free at 33.com. Bar none, one of the best personal finance blogs that ever existed. One of the coolest dudes out there ever. I love this man. Anyways, you asked me, Ian, let's say you just came to me and gave me an option. You can go to dinner with Warren Buffett. You can go to dinner with Bill Gates. You can go to dinner with Elon Musk. You can go to dinner with Tim Cook, any of these people, or you can go to dinner with Jason Fieber, Mr. Free at 33. Ian, who would you pick? I would pick Jason Fieber. This is a man who many people would consider not overly wealthy, but he's amassed a nice sized portfolio. He's moved to Thailand. He's playing geo arbitrage. He appears to be one of the happiest people that I see. And he's used dividends. He's used them in a really prolific way to retire early and to manage his costs and to basically live his dream life, live his best life. And let me tell you, I know people that have a lot of money, and oftentimes when people have more and more money, it does not make them happier. What makes people really happy is with the money that they have, if they kind of hack life. That's why I love dividends so much. Dividends are a hack. They're a way to hack the system. And what Jason did is he hacked the system. He made it work to him. He orchestrated his best life. He has basically retired and is now pursuing his passions full time, which is writing about personal finance. And it seems like he has a really cool girlfriend. He blogs about the things that they do together. They have a lot of fun in Thailand, going to movies, going to these nice meals. The food there looks really good, and just living his best life. And I always see him doing these photos sometimes where he's out at the pool. And so anyways, I'm just telling you straight up, who do I look up to more, Jason or Warren Buffett? I look up to Jason more. And so this is something, just take home for you. People who have you may be able to learn something a lot from people who have more money than you, people who have the same money, people who have less. It's not about the amount of money that someone has. It's about how they manage their life, how they manage their finances, their life, their cash flow, everything holistically. And so I think that's a really important takeaway. And so one other thing just about me. I've made buy orders in stocks as high as $10,000. I've done buy orders as low as $50. I like to average in brick by brick by brick. I started out with nothing and I built my portfolio brick by brick by brick. Most of my buy orders, honestly, sub $1,000. And so if you go to my description below, I'm going to link to a video actually that shares my buy order history so you can see. I share all the data with you of my history of buy orders. I think that tells a lot about my personal situation. And so one thing I just ask the community is you may not want to jump to conclusions when you watch my videos or when you watch anyone else's on the internet. You just want to, or quite frankly, you read stuff, keep an open mind, keep an open heart, and realize you can learn from anyone. And like I said, my personal person that I look up to, because it's not all about net worth, it's also about quality of life, that I think has really hacked the system and figured something special out, is Jason Fieber. And so the next point that I want to go into is cost of living. Cost of living is out of control. And so I mentioned in my last video, hey, the cost of Stanford right now, plus or minus 300,000, by the time my kids go, in a lot of years, my daughter's 17 years, it will probably be about 500,000 based on the information I received from my friend who's a financial advisor. When I went to Stanford not that long ago, the tuition, it's actually up 85% from when I went. It's 85% higher now in 2019 than it was when I went to Stanford. And so something just to keep in mind. But cost of living is out of control. And so many people think there's no inflation. Interest rates are coming down. Interest rates are really low. It's that way because there's no inflation. Well, let me tell you, the Fed, what they look at is something called the CPI, the Consumer Price Index. The CPI, it's not showing a lot of inflation because the CPI includes things like LCD televisions, where the price is going down over time because technology manufacturing is getting better. It does not include, though, things like education, things like housing, things like services like daycare or childcare, things of that nature. If you look at those types of classes of expenditures, they are through the roof. I personally believe that millennials, my generation, I'm one of the oldest millennials there is, have it really tough. And so I am not here trying to preach, hey, it's right that college is going to cost this much. I'm here to preach that unfortunately that's the cards I'm dealt with. And rather than look at it negatively, I still do believe in higher education. The reason I believe in it is go to Google and type in what's a starting salary at Facebook, what's a starting salary at Google, at Apple, at these types of companies that recruit from graduates of Stanford who worked really hard to get into Stanford, worked really hard on their education, were lucky enough to make it through the computer science degree. Look at what they make when they leave Stanford. When you look at it from a dollars and cents perspective and you look at it that way, it's not money thrown away on an education. Quite frankly, it is an investment, and it allows the student when they graduate to earn a lot of money, even in their first year out of college. But let me tell you, after about 5 years, that salary may have even doubled. And so quickly, the student can earn it back. I'm not saying all students, but the students who go to certain colleges acquire certain skills. And so that's one way I look at it as well. Personally, though, let me tell you, before I get into some data, some numbers, in my opinion, dividends are the answer. And so the reason I love dividends so much is I realize that this cost of living is out of control. The cost of living is going through the roof. Dividends, they're a hedge against this cost of living. It's automated income. The income just keeps snowballing over time. Dividends are our friend. That's why I talk about it here on YouTube. So I want to share now a few more things on the screen. I know I'm jumping around, but this is fundamental personal finance 101. And quite frankly, this is Ian 101. I want to be real with you. I want to be 100, just like The Game featuring Drake. They did a song about being 100. I want to share with you just where I'm coming from on all this college stuff so that you can get a better understanding of who you're dealing with. Because I think some people believe that I'm just trying to flaunt my money, if you will, on the internet, which is completely not the case. If I were that well off, look, certainly I'm very thankful for my life, so blessed, thank God every day. But look, let's just be real here. I'm in my garage sweating my butt off right now. Is this the picture of someone flaunting his money? I really hope not. I don't think so. But let's get into some notes. I'm going to get into some notes, and then I'm going to get into a model, because I wanted to model this more, the $500,000 college tuition, and I wanted to model what it looks like for money that's actually going into the college savings fund for if anyone else is looking to pay for college for their children. But a lot of this goes into personal finance 101 as well. So first, the notes. $500,000 per child is ambitious. I like to set ambitious goals. I realize that I probably will not hit the goal of saving the full $500,000 per child, but I like to set high goals because it stretches me. Even if I shoot for the stars and I get halfway to my goal to $250 per student, I will be doing really well. And so I wasn't trying in the last video to flaunt, oh, I got 500, oh, I'm gonna per child already in the college savings funds. No, I started with $5,000 for my daughter, and I want to have a goal of building it there, but I realize that's ambitious. I might not get there, but I better have an ambitious goal. I want us all to dream big. Title of this video today, please dream big. Don't have small dreams. Don't look down on people that might be doing better. Don't look down on people also that might have less. Learn from everyone. Dream big. That's the purpose of this. But I want to talk about the hacks. There's other hacks to save money. The student can live at home. The student can attend a more affordable college. The student might earn a scholarship, might graduate in fewer years, etc. I don't even know if my kids are going to want to go to Stanford. I don't know if that's going to be the right fit for them. I don't know if they'll get in or not. I don't know if it's going to be any of that. Who knows what the future holds? They may choose to go a completely different route. I just want to leave doors open. I know I enjoyed it there, but it's not for everyone. Maybe they want to go to Cal. Maybe they want to go somewhere else. Who knows? And so I don't know which one. The one thing I want them to do is I want them to be happy. I want them to pursue their passions. I want them to do something in life that makes them happy, because time, life, that's the most valuable thing. More valuable than money, more valuable than dividends. Top-rated universities, honestly, they have their pros and cons. Getting in, it requires extreme sacrifice. I know some of these celebrities are in the news. There's drama, but I'll tell you my story. I had not much of a life in high school. I worked really long hours. It was a lot of sacrifice. And so do I want that to be the high school experience for my children? I don't know. Maybe if they want that, but I don't want to make up their mind for them. And so I'm just trying to leave doors open here. I'm shooting for the stars. I don't think I'm going to reach 500, per student. But like I said, if I can get halfway there, hey, any way there is going to be good. And so I'll tell you, there's this thing called the Big Hairy Audacious Goal, BHAG. You hear about this a lot in Silicon Valley and tech. 500K per kid, that's my Big Hairy Audacious Goal. Will I hit it? I don't know. So realistically, and I'll show you in the model in a minute, I'm not even funding these 529s at the rate to get to the 500, but I'm still shooting for it because circumstances may change. Talked about how I'm blessed and I'm grateful. And again, I want to talk about tuition. It's crazy. It's up 85% since when I was there. And that being said, I started with 5K. I have a line in the sand. I want to share a model right now. So what this model shows is also the power of compound interest. And so a lot of people were saying, maybe not a lot of people, but some people were saying after my last video, hey, you've got 500K, this and that, ready to just send them to college and throw that money away. No, I don't. I started with 5,000 in my, that's all I said. I haven't said anything else. I typically don't disclose numbers here on this channel for this very reason, because I think it does create unnecessary drama. That said, I'm appreciative of the unnecessary drama this time because I'm using this as an example for the community that I think benefits everyone, that shares a personal finance lesson that is so important. Anyways, I did just a study. What would I have to contribute per year at an 11% growth rate? It's tax-free, thankful to the 529, to reach the 500. And so I show here just years 1 through 18. Year 1, I did nothing. Year 2, I already contributed 5. That's probably all I'm going to do this year. So I'm already behind what I need to contribute. But you'll see, if I contribute these amounts, and I front-loaded it a little bit in years 3 through 8, it's the compound interest that allows it to get to 500. So I basically, over these 17 years or 18 years, if I contribute 185,000, if it grows tax-free at 11%, which is a really high growth rate, it probably won't be that high, especially for the type of fund that it's in. It's going to be tough, but I'm just trying to give the benefit of the doubt here just for a basic model. That's how you get to the 500. And so one thing is, I think some people were coming to the perspective of the last video that, hey, you have to contribute the full 500. No, the power of dividend investing overall is compound interest. And this is just a very simple model that shows how to get to 500 over 18 years with not contributing 500. It's because of the growth rate. And the money, the sooner you get it in, the earlier tranches grows the most. And so you'll see 10,000 invested in year 2 becomes 53,000 by the time we need it. 10,000 invested in year 18, it's only 10,000 by the time we need it because we're taking it right out. And so that's the difference between investing early, investing late, letting compound interest do its magic. And so key takeaways here from this segment of the video: don't have a negative attitude towards money. Don't have a negative attitude at all towards people who may have more than you, less than you. Be careful of how you choose your perception, because you may be wrong about someone. You may be making assumptions about someone that are completely incorrect. So just be careful with that, because it's not about anything other than I'm trying to save you heartache, because it's the most valuable thing you have, honestly, is your time and your mental clarity. And by getting down about money, it messes up with your mental clarity and sets you back, I believe, in terms of investing success. I want everyone here to dream big and have huge investing success. The other thing I want to say is, I should have been better about communicating in the last one. I'm shooting for 500 per student because I have these big, hairy, audacious goals for each kid. I don't know if I'll reach the full 500 for each. I'm already behind schedule for my daughter and, quite frankly, for my son. That said, anything that I can do will help. And the beauty here is I'm also building up passive income in dividends. I'm building up passive income in real estate. I have money that I earn through working. And so by the time they are at that college level, really the way I'm looking at it is, one, I want them to be happy, go to the right place. It may be somewhere a lot more affordable than Stanford. And quite frankly, we may cut costs by having them live at home, this or that, all the stuff I talked about earlier. But it's really going to be a marriage. It's going to be a marriage between college fund and dividend money and real estate money and my salary, quite frankly. And so all of that's going to play into it to pay towards college education. And quite frankly, when my kids are in college, maybe they will hold jobs as well to help contribute to their own education, the own cost of their education as well. And so that's how I'm looking at college. But the reason in the last video I just said 500, that's how I kind of think. I think towards big, hairy, audacious goals. I set them big. I shoot for the stars. Even if I fall short, I want to shoot high, because what's the downside? What is the downside in shooting high? And so this is the takeaway for everyone in the video today. Please, please dream big. Whether it's your kids, their college education, whether it's your own retirement, whether it's your dividend income, whether it's you're starting a business, whatever it is, dream big, please. We are winners here. We are all, in my opinion, going to have huge, huge dividend growth portfolios, financial portfolios. I want to see everyone here hugely successful. I'm not trying to pick on anyone. I love you all. I love the discourse, by the way, and I appreciate the feedback on the last video. I love you all. All right, so before I leave today, in terms of full disclosure, I own the stocks mentioned today. I am long Starbucks, ticker symbol SBUX, PPL, ticker symbol PPL, Duke, ticker symbol DUK, Southern, ticker symbol SO, and Hawaiian Electric, ticker symbol HE. I own all those stocks in my personal dividend stock portfolio. Also, today's video is not financial advice. I'm not a licensed financial advisor. Today's video is just for your fun and entertainment. If you're going to go out and invest, please consult a licensed financial advisor first. Just sharing my journey here on YouTube for fun and entertainment. I'm a Thug Life investor. You want to support me, the channel, your passion for dividends, check out my merch. I'll link in the description below. Huge thank you and shout out to everyone who purchased the merch, gives me a thumbs up, a subscription, a like. It means the world to me. I work so hard here on YouTube, sweating it out in my garage right now to put out this content on YouTube, which I hope you guys enjoy. I went all out on this one today, trying to drop jewels, trying to share knowledge that benefits the community. I love you all. I'll see you in the next dividend investing video.